CPA, and today we're going to be talking about retirement and health savings accounts. So, I have a lot of folks come in that are W 2 employees that work for an employer that always ask me about tax planning while I'm preparing their tax return or in the middle of the year between tax seasons. And my standard response is almost always, well, have we hit the low hanging fruit? Right? 401ks, 403bs, health savings accounts, IRAs, spousal IRAs, all of these things I consider to be pretty low hanging fruit. So they tend to be the first things that I look for to see if we've taken advantage of before we move into other planning techniques. So for the 25 and 26 tax brackets, you can see here that if we're single and we're making under $100,000 a year, just under $100,000 a year in taxable income, if I'm putting $5,000 into an IRA, I'm going to save about 22% in federal income tax because my tax rate is in between these two figures. As a matter of speaking, and then 2.5% state of Arizona savings. So, what does that translate to? Well, on a 401k or 403b, the 2025 limitation is $23,000 in employee contributions, plus your employer can contribute whatever their match is, whether it's 3% or 5%, and that does not get added into your $23,000 contribution figure. If you're over 50, you get to contribute $30,500 as a catch-up provision, which is cool. If you have a 403b employer-sponsored plan and you also have a small business, you may also be eligible for additional retirement plan contribution planning items, which is pretty cool. But the $23,000, depending on your tax bracket, can make a significant difference in both federal and state income tax savings. Health savings accounts. First, let's make sure that we're pointing out that you're required to have a high deductible health plan in order to fund an HSA. You do not need to retain that high deductible health plan to keep the HSA. You can have an HSA without that plan, but to fund it, to put money into the HSA, you're required to have that high deductible health plan. So the HSA is one of my favorite benefits in the United States tax code today because there's a triple tax benefit. First, money goes into that account with pre-tax dollars. Second, all of the earnings on that account, or the deposits, are tax-free. Third, when you pull money out, so long as it's used for medical expenses, it's also tax-free. As you can imagine with anything, there's also a limit. The limit for 2025 is $4,150 if you're single, or $8,300 if you have a family plan. There's a $1,000 catch-up if you're 55, not 50 like with the other plans, but 55 with the HSA. I love the HSA. It's really great for younger folks before your check engine light comes on. When you start struggling with some additional medical concerns, it might be time, however, to switch from a high deductible health plan into a different kind of medical plan with smaller deductibles and better coverage. Another option for some higher earners is the backdoor Roth IRA. Backdoor Roth allows us to put money into a traditional IRA and then roll those funds over into a Roth IRA. You have to make the contribution to the traditional. You have to roll it over. You cannot just put money into the Roth IRA. There has to be a paper trail there. And there's a lot of pitfalls to the backdoor Roth IRA. These go wrong a lot. And when they go wrong, it is not a lot of fun. So it's very important that if you're going to navigate the backdoor Roth, that you have assistance. At least in my opinion, get a financial advisor, an accountant to help you with these things to make sure that you're doing them safely. Traditional Roth IRA. If you do not have a workplace sponsored plan, or even if you do, you may be eligible for a traditional or Roth IRA contribution. 2025 contribution limits are $7,000 if you're younger than 50, or $8,000 if you're older than 50. AGI limitations. AGI is your adjusted gross income. So on a Roth IRA for full contribution and you're single, you need to be making under $150,000. Married, $236,000. For a traditional IRA, so that you receive the full deduction for the contribution to that traditional IRA, and if you're covered by a plan at work, $79,000 or less in income, married $126,000 or less. But keep in mind your tax rate, your tax bracket rates, and these contributions are a big reduction in tax. They're the low hanging fruit. If you have a spouse at home that doesn't work, say a stay at home dad, if the other spouse is earning income, generating revenue, the working spouse can still contribute on the behalf of the homemaker if they're filing a joint income tax return. It doesn't matter whether you contribute to a traditional IRA or to a Roth IRA. Either one is acceptable. You have the same contribution limits as a regular, taxpayer-funded, self-funded IRA or Roth IRA. However, you cannot contribute more than you generate in revenue. So if you make $12,000, you're not going to be able to max out both spousal and self-funded IRA. You still have the same income limitations as on the previous slide as well. For low to moderate income tax filers, there is something called a saver's credit. And it has some limitations as well, because of course it does. But the credit maxes out at $1,000 per person. So it can be a great incentive for low to moderate income filers to save. So our key takeaways, again, low hanging fruit. You want to fully fund a 401k or a 403 first. They're often your largest and most accessible tax saving tools. HSAs offer triple tax benefits: free money in, no tax on earnings, free money out. It's amazing. IRA contributions, first and foremost, if you're not covered by an employer-sponsored plan, even if you are, you may be eligible. For higher income earners, backdoor Roths. For low to moderate income filers, the Savers Credit is available for us. Let us know if you have any questions. I'd be happy to answer and help. Have a great day.